For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thanks so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about today's economic, market, and political news that retirees need to know. Also, risk tolerance versus risk capacity and why retirees many times get this wrong. Retirement account mistakes that send money to the wrong people. And finally, the retirement problems that you can't fix alone. My name's Jeff Shade. As always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from Randy and Jake Floyd of Floyd Financial Group. Hey, Randy, how you doing today?
Doing very well, Jeff. How about you?
I'm doing fantastic. And Jake, how are you doing this Memorial Day weekend?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope everybody else is having a great Memorial Day weekend out with the barbecue, the hot dogs, and the hamburgers, recreating, maybe out on the lake. Have a great time, but remember what Memorial Day is all about, and that is to thank those people who made the sacrifice for our freedom. Okay, guys, let's get started today with today's economic news, market, and political news that retirees need to know. Interest rates are staying higher for longer. Inflation is still biting. Markets are near highs, but some risks, I understand, are building underneath. If you're retired or getting close, this may be one of the most important planning windows that we have seen in years. So today, let's break it down on what's happening right now and what you should actually do about it. Randy, let's start right there. Everybody thought rates were coming down fast this year. Now it looks like higher for longer is the reality. What does that really mean for retirees, and why are these rates staying higher for longer?
I think you're right, Jeff. I think that recently we've had some information come across on the producer price index that was a little alarming to people. That coupled, of course, with the Iranian deal that we have going on in the Strait of Hormuz and higher oil prices, really does kind of put Kevin Warsh, our new guy, in kind of a predicament, kind of a hard spot. I think that we've been seeing that bond rates have hit all-time highs. We've seen a few nations dump a few treasuries, nothing of any real consequence at this point. The consensus would be from the Trump administration, they would want him to cut rates. However, I don't know that he can do that in face of a 1.4% month over month, that was from March to April, increase in the producer price index. So right now is probably a time to really be watching what's going on. It might even be a time to take a little risk off the table. We're certainly watching it very close every day.
And it is really a double-edged sword with these interest rates. On one hand, the interest rates are staying higher for people who are borrowing money. But on the other hand, for things like cash equivalents, it's a good thing when we're talking about CDs. Where are CDs and cash equivalents standing right now today?
Well, you know, they've been steadily decreasing. I think the banks had kind of seen the handwriting on the wall, so to speak, that they thought rates were going to come down. Inflation did look like it was becoming a little more ruly than it was for a while. Of course, this last deal with the oil prices going really high, that translated into the PPI, and they said, well, we backed it out. We took out oil and gas. First of all, you can't take out oil out of the equation no matter what you try to do, because oil affects everything. You just can't back that out. So I think, again, the key here is to get this Iranian thing a little bit more under control, and I think we'll see some more room for growth.
Now, Randy, as far as CD rates go, inflation is what, around 3%? Are we getting even 3% on CDs? What I mean by that is if you invest in a CD, are you really even keeping up with inflation these days?
Yeah, that's a good question. I mean, I think that if we look at what banks are doing right now around the countryside, where I'm seeing and hearing 3.5, 3.75, maybe even some 3.9s, but there's no length available. 6 months, 7 months is all banks want to do. Again, because of the volatility of interest rates and potential for volatility, they're just not willing to sign up for anything long-term right now.
So, Randy, I mean, a lot of people have CDs in their portfolio. Why would someone put money in a CD that's paying just barely above what the inflation rate is?
Well, the biggest thing would be fear, right, Jeff?
Yeah.
They're afraid that maybe they're going to go into the market at the wrong time. I mean, here we are at near all-time highs right now. But, you know, as Jake has said on here, the market does climb the wall of worry.
Yep, we're almost in time for selling May and go away here.
Yeah, even though May has got like another week left here. Memorial Day, boy, it came early this year. Inflation isn't making headlines like it was before, guys, but people still feel it every single day. I certainly feel it when I go to the supermarket and when I buy almost anything, Home Depot or Ace Hardware, the places that I normally go. What are you guys seeing as far as inflation goes, and how is it affecting the everyday retiree?
Everything has a lot of price pressure up. The one thing that I would say, and I know even for myself that this is true, there still are good deals to be had. It's just that you got to search for them today. If you just go up and down the aisle at the grocery store and just pick stuff off the shelf and just put it in your basket, I'll promise you're paying more than you probably ever paid even right now. But the thing is, if you're a little bit selective, I used to work for a big cheese company a long time ago, and I was a really loyal customer of theirs for a long time. But I will tell you this much, they priced me out of the market. When I can get a very, very similar product or the same product, probably made on the same line, to be honest, for 40% less, I'm done with that. And we as consumers, I think, still have a responsibility to be wise shoppers. And so we need to be focusing on, right now, making sure that we don't have any holes in our buckets or as few holes in our bucket as possible. And that is, let's look at what is going on with our income? How much are we spending? What about tax efficiency? What's really happening in our portfolios? And if we haven't had a review in a while, we should sit down and do that and really talk about what expenses look like and what things might need to be trimmed here for a little while, or maybe even indefinitely. I know Lisa and I, we started using a program that basically helps us track our expenses. And what's interesting is once you really start to track things, and we've said this on the show before, anything you measure tends to what? Improve.
Right.
And so we're finding the exact same thing.
Yeah, and I know that some people have these apps. I know that Dave Ramsey has his Every Dollar app, which tracks expenses. I've done it the old way. I have a little notebook, and I would put down everything that I spent even just a few cents on for a month and doing it the old-fashioned way. But you are right. Every month that I did that, I was very surprised at what I was spending money on. We're talking with Randy and Jake of Floyd Financial Group, and we're talking about current events, we're talking about inflation, and we're talking about having a plan and taking a look at your portfolio. If you do not have a portfolio, if you'd like some help with your journey towards climbing that retirement mountain, call 417-889-7233. Request your Floyd Financial Group financial review. Absolutely no cost and no obligation. 417-889-7233. Randy, you mentioned earlier that markets that are an all-time high, but I understand that risk is rising. Why is that?
Yeah, so, anytime we look at the pricing of a stock market and what's going on, the market tends to look down the road and try to price in what's coming, right? So with AI, the advent of that coming along and pushing valuations higher and higher, and while things look pretty good on the surface still, and we see that profitability of these companies has really been strong, and even though valuations are higher, if they do start to falter and not make their top and bottom line numbers, certainly that's going to cause a pause in what the market might want to do. Or there may be some people that say, you know what, we've been hanging out here and watching this thing go up, 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 up. And as they see maybe the risk increasing or the fact that maybe they're missing some of their numbers, they may say, you know what, it's time to reallocate this money someplace else. So yes, always as markets go up, risk tends to go up. Why? Because you're pushing the edge of the envelope, and that's just always the way it goes. It's like when I'm riding my mountain bike, if I'm doing a little bitty jump versus a great big jump, the risk goes up.
That's right. You have been in this business for a long time, Randy. Have you ever seen a bull market that has run as long as this one has?
Well, actually, we did. The last time Ben Bernanke was our Fed chairman back in 2009 when he started in 10, 11, and 12, printing money with zero interest rates, $3.5 trillion of quantitative easing through there, he called it at that point in time. We saw an 11-year bull market, which actually ended in 2020 with the advent of the COVID-19.
So what do you think it's going to take for this market to turn from a bull to a bear?
Well, again, if companies cannot make their top and bottom line, eventually the price-earnings ratio comes into effect. That is, if companies can't sell and can't make bottom line, then that's going to change. People are going to move money elsewhere to look for where they can make those numbers. And that's always what it comes down to. Eventually, companies must make money. Yes, we can speculate and we can look down the road, but we need to see some real proof in the pudding, as my dad used to say.
So, Randy, what goes up comes down. Is a market burst imminent here, or do you think we can ride this thing out even longer?
We know that historically, about every 4.5 years, the market has to run a cycle. And even within a bull market cycle, there can be moments of, in fact, if you look back, generally every 12 to 18 months, there's a 10% correction factored in there. How long do they last? Sometimes 50, 60 days, maybe sometimes as long as 6 months. But we always have that ebb and flow. And why is that? We've said this before on the show. Anytime that there is a transaction made in the market, there's two people involved, and they both think they're right. Only one actually is.
Well, let's bring politics into this discussion here today. We haven't talked about it yet. Tariffs, deficits, government spending, the war in Iran. How much does this matter to retirees, what goes on in politics?
They may not think it matters to them, but it matters a whole lot. I mean, if we're talking about market direction, how much money they're making, those are the things that drive markets. Now, again, to Randy's point earlier, when it comes to long-term market performance, it's going to come down to earnings mainly. Earnings and revenue. How much business we're doing, how much money we're making. And if the money you're making keeps going up, your stock's going to keep going up, all things equal. But in the short term, the back and forth, the jockeying for position ahead of midterms, ahead of the next presidential election, all those things are going to matter. The Iran thing's going to matter. And really, again, mainly because of the price of oil. But there's a lot of these things that really come into focus as we're trying to figure out what the next direction we're going to go. You know, is the next 10% up or down? And if you had the crystal ball on that, you'd be a very wealthy person. But the market can always have a correction. Most of the time, it's not correcting. It's going to new highs and new highs and new highs and new highs. So if you sit around waiting for the correction forever, you're probably going to miss out. That being said, the next 6 months or so, historically, 6 months prior to a midterm election is generally not a great time. Historically, there's been some exceptions, but you need to have a plan and an investment setup that works no matter what the financial weather is.
And again, to get that plan, 417-889-7233. You can make that call right now. If I'm hearing you correctly, Jake, are you saying that markets are reacting to Washington almost as much as Wall Street right now?
Oh, I would say even more. If we were only focused on Wall Street, I think stocks would be much higher. And I think there's a lot of political and geopolitical issues that are holding it back at this point. So, yeah, I would say that's definitely what's happening.
All right, guys, so let's bring it all full circle here. What should someone actually do right now if they're retired or they're close to retirement, considering what we've been talking about here for the last 10, 12 minutes?
Well, if you haven't been on a regular review schedule with your advisor, you need to go have one. And just simply because, like Jake said, the market is up most of the time, but the down stuff can kill you. And especially if you don't have someone to guide you. A lot of times what happens is when markets get really high like this and people get nervous and they jump out and then they don't know when to get back in, or if the market starts to go down and maybe it's down 10 and they think that this is it, this is the big happening, the cataclysmic event. Once the market bottoms out, they never know when to get back in. They miss out on a lot of the gains. Again, we know that systemically the market's always done this. It's gone up, it's gone down. Uncertainty like governments and the Strait of Hormuz thing we're going through right now with tight supply lines, on oil, the COVID-19 thing. I mean, if we look back just the last few years, just think about it. Since 1999 and 2000, we've had the dot-com bubble. After that, we had 2007, 8, and 9, the financial crisis. Then we've had COVID, and now here we are with the Iranian thing, right? So, there's always going to be something out there. And so what you need to have is a plan that allows you to be on the offense when markets are growing. But you need kind of like a storm shelter in the garage at my house. My wife said, we're going to buy this house, but I'm going to have a storm shelter. So that's kind of the same thing in your financial plan. You need to have a plan that puts you in a good position to grow your money when things are good, but also to give you some downside protection so that you can recover after that bad time passes.
This has been a great conversation, guys. If you're within 5 to 10 years of retirement or already retired, you can't afford to guess right now. Markets are near high, interest rates are elevated, inflation is still quietly eating away at your purchasing power, and one bad sequence of returns early in retirement can do permanent damage to your portfolio. This is not the time to hope that it all works out. That's why Randy and Jake here and the team at Floyd Financial Group are offering a complimentary Floyd Financial Group retirement review. They'll show you in plain English where your plan is strong young or it may be exposed, and how to create real, reliable income in today's environment. If you'd like to take advantage of the opportunity, there is no cost, there is no obligation, and there is no judgment. Call 417-889-7233. It's 417-889-7233 for your Floyd Financial Group Retirement Review. As I said, it's not going to cost you a dime, entirely complimentary. Don't wait for a problem to show up. Find out now if you're truly ready. Well, Randy and Jake, it is time for a break. We come back here on Show Me the Money. We're going to be talking about risk tolerance versus risk capacity and why retirees sometimes get this wrong and what the consequences can be. When our show continues here on 104.1 FM, KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about risk tolerance versus risk capacity.
Randy, you ever notice the market drops 20% and suddenly people realize that they weren't as aggressive as they thought they were? Well, today we're talking about one of the biggest disconnects in retirement planning and what you feel you can handle versus what you actually can handle. So, Randy, let's start simple here. What's the difference between risk tolerance versus risk capacity, and why do people get this wrong?
Yeah, so we deal with this a lot. The risk tolerance portion of this is people say, well, I'm pretty tolerant. I can take a lot of risk. In fact, I had one guy say, listen, I don't care if you lose it all, just make me some money. Now, if you think about that, that's an oxymoron.
Yeah, I was just thinking that.
But I mean,
lose it all, but make me money. Okay. Yeah. How are you going to do that?
Yeah, that's kind of a hard one there, I kind of go back to what Will Rogers said, don't tell me about return on my money, tell me about return of my money.
That's right.
That's what it amounts to. So, yeah, risk tolerance is how you feel emotionally and psychologically about how much risk you can take. And there's people that say, hey, if I have too much risk, I can't sleep at night. So that's the risk tolerance portion of it. The risk capacity is basically based on your situation, the income and the budgeting that you need. What is your actual capacity? How much risk can we take and not put you in harm's way? So the big deal is one is a math problem and one's an emotional problem. And we are emotional beings, and there's no denying that and no escaping it.
Right. So why is this such a big deal, Randy, for retirees or people near retirement? If you get this wrong, if you are too conservative or maybe you're too aggressive, how can this harm you?
Right. Well, if you're too conservative, you're not going to make enough money to support your retirement. If you're too aggressive and you lose too much and you still need income, remember that when markets go down, you still need a paycheck once you're retired, right? Because you're not working anymore. So even though the market's down 20, if you need 5%, you're down now 25%. So for you to get even, you got to gain back like 30%. And generally markets don't grow 30% in a year. So it may take you years to actually overcome that downturn. And if you're really over risked, it could be even worse than that.
So the way I think about it is your money is sort of like your employee and you're the hard driving boss. You got to make that money work for you. You got to keep an eye on it. Make sure it's not goofing off, right? Make sure it's not lazy out back.
Exactly right. My dad used to say, we got to make hay while it's time, when it's season. We got to do it now. But we also got to make sure that once we have made the hay, we put it in the barn for safekeeping, right? So we got to have both sides of that. We've got to be able to grow the hay. We got to be able to bale the hay. And they both have a different purpose. One is for the future, one is for now and feeding the cattle this winter, right?
Right. And I'm not necessarily a gambler. I don't bet on things, but I've heard that if you go to Vegas or you go to Atlantic City or you go to wherever there's gambling, that ultimately you want to play with the house's money, meaning that you take money to bet or you're not really investing it. But the whole goal is to not lose what you came with and just play with their money. Would you say that that is a reasonable analogy for investing?
That's a fairly reasonable analogy. I will tell you that that's not always possible to do. But the one thing we can do by investing money wisely, we can kind of mathematically determine what is our max downside going to look like and what's our upside going to look like. We want to try to get as much of the upside gain of the market as we can, because really there's been no other investment over time that gives us liquidity and growth like the stock market. Nothing else has. That's really been the big winner long term. But we also have to make sure that we have built-in systems to give us some protection against the real downside.
Randy, how common is it that you get a client in front of you and they say to you, Randy, I don't want to lose a dime of my money. I don't want to take any risk whatsoever. Just put me in the safest thing possible. When in reality, that is not the right thing to do. You've got to take a little risk in order to make money. Is this something that is common? And how do you deal with somebody who just wants to stay totally on the safe side of things?
I would say that it's somewhat common. The real risk may be that by being so conservative, you're at more risk than if you put it in the market, because you're going to get eaten alive, especially when you are just simply spending your principal to live on.
Yeah, the mattress isn't really good at growing capital.
That is not as safe as it could be. We're talking about CDs and safe money investments, money markets and things like that. But what if you had all your money in CDs and money markets and maybe a little under the mattress? You know, these were really, really safe investments. With inflation the way it is today, you're not making any money. And if you don't make any money with your money, is that a recipe for disaster later on in retirement?
It certainly can be. I will tell you, though, that there are a group of people out there still that can absolutely live on their Social Security. So any money that they have in their mattress, short of it burning up in a house fire or in their wall.
They have to use a fire bag at least,
in their wall.
For goodness sake.
Yeah, there are people that can do that. It's certainly not a comfortable retirement, and most of the people that I know that have done that have paid a price for quality of life in many cases too, of trying to squeeze the last drop out of every, penny, that little, I guess you can get blood out of a penny. I don't know. But anyway.
I don't know.
You can get it out of a turnip, apparently.
That's right.
Yeah.
I've got one here. I think I'm going to pinch it until Abe Lincoln cries.
Yeah, but it's one of those things that everybody's risk tolerance is different. And what we want to do here is meet people where they are, but also educate them that there are ways to get stronger returns on their money and not take too much risk and give them a better quality of life in retirement.
And when you talk about stashing cash, I remember I had an uncle who was relatively well-to-do. Actually, he owned a gas station. And what he would do is, you remember in the old days when you'd pull in and get gas and the attendant would put the gas in your car and you'd give him $20 or so and he pulled out a huge wad the size of his fist of money. Remember that? And he would just peel off what your change was going to be. Yep. Well, he would collect a lot of cash and he would go, I think, about every 2 years or so and buy himself a new Cadillac. He would bring in cash and the dealer would take that. Well, today, since 9/11, it is entirely different. I mean, cash, as they say, is trash. If you've got a bathtub full of cash, you really can't use it for anything, can you?
Yeah, I mean, I guess you can. There's still some people that will take cash. I guess you could go eat out a lot and pay a lot of tips or something like that. But yeah, you're right. I mean, just having cash sitting around, you need a certain amount, yes. We like for everybody to have somewhere between 3 and 6 months of ready cash in case the roof leaks, the washing machine breaks, the car breaks, or you need some tires or whatever the case may be.
That cash doesn't necessarily need to be physical cash.
Correct.
Right. That money could be in a checking account. And I think what Jeff is saying, too, is having actual physical cash.
Yeah, if you stuff it in your mattress, you're exactly right. And you take it into the car dealer and you give them $40,000 in 20s, they're not going to take it because they don't know where it came from. Or if you buy a house, I went through that.
Toss them a duffel bag for the
That's
Lambo.
Right. It's not like Sopranos on TV or something. I mean, you bring some cash in. I had like $45,000 in cash. Nobody would take it at all because they couldn't trace from where it came.
Well, it's like for us here, we can't take cash here at all because of we're the first line of defense against anti-money laundering and that sort of thing. So you're right. I mean, cash kind of is trash today. And it's kind of funny, though. Once in a while, I'm out with my wife. She usually has some cash and something will come up and we will need it for something. But generally speaking, I've got a couple of credit cards, my driver's license, and my Blue Cross health insurance thing in my pocket, and my key fob, and that's it.
That's all you need to get by in life. Is I keep about 2 or 3. I mean, I'll keep less than $5 in cash in my wallet because they're taking debit cards pretty much every place else. And since the TV series Ozark, I don't know if you guys watched that as well too, but that really taught people how to launder money, and I think things became a little more stringent after that. Talk with Randy and Jake Floyd Financial Group. We're talking about risk tolerance versus risk capacity. So what happens when someone's risk tolerance and risk capacity, they don't match? This is a big problem. I mean, how do you solve something like that?
It can be a challenge. Generally speaking, though, what we find is we can kind of start people where they're comfortable and maybe expose them to a little bit more and a little bit more and a little bit more. And again, we don't take reckless abandon with people's assets. I mean, we try to value their opinion and where they are and certainly stay within their risk tolerance. But we do like to educate people because many times we're not very good at educating people on money in this country. They just haven't been exposed to some of the things that are available. So we're all about education and helping people to understand that there are safe ways to earn more than you can generally earn from a bank CD.
And Randy, you've talked many times about having couples in front of you in the office, and there was a famous story of the couple who was going to go out on the road, and he had the RV with the antenna on the top of it. He's going to check his stocks and his investments every day. And his wife said, well, if he's doing that, I'm not going on vacation. People really have different opinions on things, and certainly safety is one of those too. Risk tolerance versus risk capacity. Is this something that you find once in a while where the guy says, put it all on red, and the woman says, I don't want to risk a penny whatsoever? When you have something like that happening in front of you, first of all, is that common? And if you do have different opinions, how do you work with somebody like that or a couple?
It's generally true that I would say in most cases, and not to stereotype, but I would say generally the man is a little more risk tolerant and the women are a little bit more risk averse.
Sometimes it is the opposite, though.
Yep, it does happen. But this idea that everybody is completely congruent in their thinking about markets, I will tell you, just between me and my wife, Lisa, totally different thought processes on money. However, after 44 years of being together, she now says, well, I want you to do whatever you think is right.
Well, I remember when you bought your house, didn't she say, I want a paid off house? I don't care what. When we're in retirement, I want the house paid off. But you've often said that your house is going to appreciate whether you own it or not.
That's true. And then if you've got a really low interest rate on your house of 3%, 3.25%, there's even some 2.99s out there. It doesn't always make sense to own your home. Now, from a cash flow perspective, it may still make sense to do. Everybody's situation is different. But when it came time for us, Lisa said, hey, no, just no debt. Just say none, zero. I said, yes, dear.
That's your secret to a happy marriage here. If someone listening to the program today doesn't know whether they're taking too much risk or not enough risk, is there a way for them to come in and sit down with you and really figure out what is the right amount of risk that they should be taking? I mean, how do you handle such an emotional type of thing?
So I think there's two phases to that. Number one is people need to come in and just sit down with us and get to know us. And then what we'll do is take them through a little process of just educating them about what's out there. Many times people have thrown money into their 401k for the last 35 or 40 years. They maybe got a couple of bank CDs, or maybe they got a money market at the bank, and that's really kind of what they've been exposed to. They haven't really had much experience with investing outside of their 401k and what was available maybe through a bank, like I said. So there's lots of things that need to be talked about and understood, and I think that's the first step, is just to come in, sit down, let's talk about it. Let's really go through. We have a risk tolerance questionnaire, and it's really quite simple. It's not where we're having them sit down and do long-form math and that sort of thing. These are basic questions that deal with, like we talked about earlier, risk capacity and actual risk tolerance. And so the emotion and the practicality is what comes out as they're educated.
Well, around here in the Ozarks, people didn't gamble with what they've worked their whole life to build. You didn't put in 30, 40 years just to roll the dice in the last 10. Here's the truth. If you don't know what your risk tolerance and your risk capacity is, you are guessing. And guessing is exactly what gets people into trouble when the market turns. That's why Randy and Jake here at Floyd Financial Group are offering a no-cost retirement review. They'll show you plain and simple where you stand, how much risk you're really taking, and whether your plan actually holds up. So if you would like that at no cost, no obligation, and no judgment, call 417-889-7233. It's 417-889-7233, because here in the Ozarks, we believe in common sense, not guesswork. Randy and Jake, time for a break. We'll come back here on Show Me the Money. We're going to be talking about retirement account mistakes that send money to the wrong people when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Well, welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about retirement account mistakes that send money to the wrong people, Jeff.
We don't want that to happen. This might be one of the most shocking things that we've ever talked about on this show. You could do everything right, save your whole life, have a will, even a trust, and your retirement money could still go to the wrong person. We're talking about ex-spouses, missing kids, even people that you never intended to inherit a dime. So, Randy, most people think their will controls everything, but that's not true when it comes to retirement accounts, is it?
No, that's true. I mean, the will is basically designed to take care mainly of personal property and that sort of thing. Now, can it direct? I guess it sort of can, but typically if you have a will and you only have a will, you're just going to end up in probate, and then ultimately the court's going to decide who gets what. So, if you're looking at your 401k and your IRA, those things are controlled by beneficiary designations. Those forms are legally binding. They will override your will and your trust as well. So if your will says leave everything to my kids, that may ultimately end up happening, but it's going to end up going through probate because without specific beneficiary designations, the court's going to have to get involved to see who actually gets that stuff. So, if your beneficiary says ex-spouse, here's the worst one.
Yeah.
Is when people put a beneficiary designation of my estate.
Oh,
the estate of.
Right.
That's not good.
So the purpose of this whole conversation is to make sure that your beneficiaries are right. And as you said, the beneficiary form overrides the will. Have you ever had someone come into the office, Randy or Jake, who've brought their will, they pull it out, and it looks like the Declaration of Independence. It's all yellow and it's tattered. It looks like it's been through the wash a couple of times. And you take a look at it here and it says, oh yeah, then this is Jimmy. And how old is it? Well, Jimmy's 37 now today. Has that ever happened to you where they bring in old wills like that? Things are just totally wrong.
Oh, sure. I always tell people, if you haven't had your estate plan updated since your kids were little, your brother still does get your kids, right?
Yeah, right.
I would say actually most times that I see a will, it looks like that.
Now, does your brother, Randy, does he get Jake if something were to happen to you at this point in time?
Yeah. He'd probably love to have Jake at this point in time.
Jake's 43.
But that's the way it was in the beginning. But a lot of people do that. Hey, sis, if something happened to me and Jim over here, you would take our kids, right? Oh, of course. But now that they're 50, it really doesn't apply anymore.
You can't be aging me, though. I'm only 41. I got 42 coming later this year.
Sorry about that.
Just saying.
Well, you've got the maturity of a 43-year-old. Let's put it that way.
Well, thanks, I think.
Yeah, no, that's...
He's a sage. At 41, he's 66 in good sense.
It was meant as a compliment there, Jake. So give me the nightmare example, the scenario, Randy. What actually happens? If you got a little story, maybe a classic story about what could happen here.
Yeah, it happens when people get divorced and people get remarried and we got yours, mine, and ours, and people forget to change their beneficiary designations and the IRA is still going to the ex-wife or the ex-husband. The kids get left out. There's just so many things that can happen. And even if you've had the opportunity to sit down and work with, and I want to be gentle, I want to be careful on this, with a less experienced estate planning attorney.
That's pretty gentle.
Here's my reason I bring that up. There's people that live in smaller towns and where we have attorneys that have to practice in virtually every area of law to have enough business to stay in business, right? Because if you're specializing in just divorce and you live in a town of 500, there may not be enough divorces going. Well, maybe in today's world there would be. If you're the only attorney, I guess. But anyway, I mean, the long and the short of it is they have to practice lots of different areas, so they may not be quite as up to snuff on those areas as they would need to be. Case in point, let's say we've got a farm that mom and dad are going to divide amongst 3 kids. So when they pass away, it says in their trust, and we've seen this where it says, well, the kids each get a third. So when it comes time to divide the land, it may be that one kid says, well, I don't want any land, I just want money. The other 2 kids may not have the money to buy out that one kid, so what do? Well, that's kind of a problem. So we need to kind of spell that out, right? So the other thing that we see sometimes is they have an undivided interest in a piece of land. Now, I don't know about you, Jeff, but around here in the hills of Missouri, not all land is created equal.
Yeah, but the kids will never fight.
Of course they won't. Yeah, just
Right.
wait till you put money between them. But you're right.
So-
Some's rocky and you can't do a darn thing with it. Others,
Right.
other land is fertile and you can grow a good crop. But
And we
you're
knew
right.
that mom and dad wanted me to have that best part up front. After
Well, of
all, I'm
course.
the youngest.
Yeah.
So,
Well,
or
it's
how-
mother's brothers. Mom always liked you best.
Yeah, I mowed the lawn while Dad was in the nursing home.
Yeah.
Right.
There you go. So, yeah, there's just all sorts of things that can come up with something like that. So, you need someone that's really been down the road and had some experience with setting up estate plans. And here's the thing, there's this thing that I've heard that, and I'm not an attorney, so I can't speak to this, but I've heard of this term called the parade of horribles. And the parade of horribles is all the bad things that can happen. One situation, we had this client, this has been probably 20 years ago. This couple came in, and I don't think Jake and Elizabeth, they might have been just brand new here. It's been 20 years, I know. They were brand new here, I guess, and this client came in, we got to know him really well, and so all of a sudden, about 8 months into retirement, he dies. So his wife comes back to us, and she's telling us the story, and it's horrible. So anyway, she was pretty fragile at the time, and we just felt like we needed to go to the funeral, even though the funeral was down the road about 100 miles at a little town called Willow Springs.
Mm-hmm.
So we go to this funeral, and we're walking with the spouse of the guy that passed away, and he had brothers and sisters. Now, this couple owned some cattle, and they had cattle on one of the sisters' property that they were renting. So as we walk by the sister of the guy that died, we said hi, and she said to the spouse of the guy that had died, "Get your effing cattle off our
Oh my
property."
gosh! At a funeral, you
I
couldn't
was
just
like-
hold that for another day.
Yeah, I'm like, I mean, and she was just mean as she could be
Oh
when
my
she did it.
gosh.
So anyway, you just never know what. I will say this, that typically speaking, when somebody dies, if there's going to be any conflict, that's when it'll be.
That's a great story. I'm glad you told that one.
Well, I'm not sure it's a great story, but
Well, it's a good story to make an example, not a great
Yeah.
story. But what I
Just-
meant was that, believe it or not, these things do happen. So besides a will, Randy, what are some of the other things that have beneficiaries that people need to pay attention to?
So here in Missouri, we get to use a beneficiary deed to pass property if we don't want to have a trust. Now, the only trouble with the beneficiary deed, in my experience, has been this. And again, I want to be clear, I'm not an attorney. My experience has been that when we have a beneficiary deed, if we have, say, 3 siblings that are going to inherit this and they're all married, the disposal of that property has to be signed off on by all parties, including the spouses of those people that inherited. So that kind of creates a problem. If you got a single person, I guess a beneficiary deed avoids probate and gets it passed the way you might want to. But you need to have powers of attorney for finance, for healthcare, especially for finance, especially in today's world where people have lots of IRA money. A lot of people don't realize that if your husband has a big IRA and he is incapacitated in a nursing home and you don't have a power of attorney, you'll have to go and get a guardianship probably over him and a conservatorship over the money before you can access it. Not just as a spouse can you access that, but with a power of attorney for finance, with the right language in it, you can access that easily. And that can be put on file with the IRA company, whoever holds that, whoever has custody of it in advance, so that that's not a problem. But there's just a lot of things that people don't think about. The bank will generally give you a first line of pay on death, but many times they don't even ask you about a contingent beneficiary, and a lot of times people don't have a contingent beneficiary at all on those accounts.
Talking with Randy and Jake Floyd, Floyd Financial Group, we're talking about beneficiaries and how not having the right beneficiary on your assets could mean trouble. Randy, this recently got worse with the new tax laws, right?
Right. So the Secure Act 1 came in right around COVID time and changed a few rules for IRAs. And then Secure Act 2 was a couple of years later than that. And basically what has happened is it used to be if we had a non-spouse, in other words, somebody that you weren't married to, a non-spouse beneficiary, we could do what's called a stretch IRA. And the stretch IRA would allow you to stretch that over their lifetime. Well, with the latest on the Secure Act, now all non-spousal beneficiaries have to withdraw that money out over 10 years. Which could be that you're going to have a bigger tax bill than you would have had and might put you into a higher tax bracket. So it could be that the IRS becomes almost as big a beneficiary as you are, right?
Yeah.
And it might just upset the planning that you have done for your IRAs and all those things in your lifetime once you inherit this. So really it's something everybody needs to think about and talk about and understand that now you have to take that money out within 10 years, where it used to be you could stretch it over a lifetime. So really, it's something that helps people to think about, well, do I want to distribute some of this money now? Do I want to convert some of this money potentially to a Roth IRA to help mitigate taxes as my beneficiaries inherit it? So there's just a lot of things that come down with Secure Act, but this is one of the biggest ones.
And Randy, this has been such an important conversation here. Do want to point out to our listeners that this is not a small mistake. We're talking about your life savings here, your 401k, your IRA, possibly going to the wrong person. You could have a will, you could have a trust, and none of it matters if that beneficiary form is outdated. Here's the part that should bother you. You won't be around to fix it once it happens. So if you've been divorced, remarried, changed jobs, or haven't looked at your accounts in years, you're at risk right now. That's why Randy and Jake and the team here at Floyd Financial Group are offering a no-cost, no-obligation retirement review, which will take a look at your beneficiaries. They'll go line by line and show you exactly where your money is going and whether it matches what you actually want. If you'd like that, call 417-889-7233. You can do that right now if you want. It's 417-889-7233. Leave your name and number. Ashley will reach out to you and schedule that appointment. No cost, no obligation, and certainly no judgment. We'll meet you where you are. Because if you don't fix this, the wrong person could end up with everything. It's 417-889-7233. Okay, Randy and Jake, let's take a break. When we come back, we'll wrap it all up by talking about the retirement problems that you can't fix alone when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about retirement problems you can't fix alone.
And you know, Randy, most folks around here in the Ozarks, they've worked hard, they saved what they could, and now they're getting close to retirement thinking they should be okay. But then reality hits taxes, healthcare, market swings, and suddenly, well, it's not so simple. Well, today we're talking about the problems that retirees face that they can't fix on their own and the mistakes that can quietly cost them thousands. So let's start with the big one, Randy. What is the number one thing that you hear from folks who are walking into your office and sitting down to talk to you?
Yeah, you know, it's been said, Jeff, that running out of money, people are more afraid of that than death in some cases.
That's amazing.
Because, I mean, let's face it, if you're going to run out of money and you're still alive, that's not a good thing, right?
No, not at all.
But yeah, that's the big one that we probably hear. Because again, people have saved money for 30, 40, 50 years. They've always had a paycheck based on so many physical movements they sold their body for to perform each day, right? And then all of a sudden they come up to where now they're not working anymore. And they look at this pile of money, but they don't really understand what it means as to what a monthly income could be off that. And what happens if I have I got to have a new car, if I got to fix the roof, or something major happens, or I got to help my kids? What happens during all that, and how does that affect my portfolio? And can I afford to do certain things? I mean, many times we see this where kids will come along to mom and dad and say, hey, we got this great business idea, and we want to start a business, and we thought maybe you'd like to fund it for us, you know? And so
yeah, right.
Sometimes it's okay, but again, we always have to realize, you know, if they come and they ask for $250,000 to start a business, it's going to cost us $330,000 to fund that, because we got to pay the taxes if it's coming out of an IRA. So taking too much in withdrawals, giving away too much money early on can put you in a position that you don't want to be in, where you could be short of living expenses.
And we're talking about mistakes that you can't fix on your own, and running out of money is such a big mistake, Randy. Why can't people just fix that on their own? Is it really that complicated?
Well, again, I think one of the biggest things that comes into play here is not only maybe inexperience, but also the emotion that's tied to managing your own money. And let's face it, money gets to be pretty emotional, as we kind of alluded to earlier. Sometimes people handle stress differently than others, right?
It's like that. If you can tell that story of the girl, she was in the office and you were talking to her, and then you said we should get down to business, and she called it scary money stuff.
Scary money stuff, and that's exactly right. And that's really one of the key things here that we try to do is we want to educate people to the level they want to be educated to, right? We don't want to try to overdo that. But having a reason and an explanation and an understanding of why and what we do with money really helps people to get comfortable with their retirement plan. And also understanding, you know, how much can I really withdraw and make sure that I'm not going to run out of money too soon. That's the thing that really gives people, as one guy said, sleep insurance at night, I guess.
Right. And when she said scary money stuff, I think what she meant was that money scares her because it had control over her. But what you do at Floyd Financial Group, and correct me if I'm wrong, is that you are the boss of your money. You make it do what you want it to do, right?
Right. So the deal is, because they don't necessarily understand exactly how all these investments work, that makes them not have peace of mind. And we want people to have peace of mind in retirement. In fact, it wouldn't be retirement if you just had to worry about it every day, right?
Right. And people worry about most things that never happen. You want to be a slave-driving boss when it comes to your money. You've got to make your money work, because if you don't, it'll just sort of goof off and it'll sit there and absolutely do nothing. We're talking about retirement problems here that people can't fix on their own. Let's talk taxes a little bit, Randy, because a lot of people think that once they retire, their taxes are going to go down. Now, that is not exactly right, is it?
It's not necessarily true. I will say this. The thing, of course, that you don't pay anymore is Medicare and Medicaid and Social Security. However, depending on what your income is, you may be subject to this old girl named IRMA. So IRMA
I've heard of her.
is where if you have too much income coming in, you may have to pay more for your Medicare benefits. So that's one of the tax traps that we see that's out there. Many times what we see is when people come in and say, hey, if you got a good tax person that I can take my taxes to, well, yeah, we can probably recommend somebody. But thinking about taxes in arrears is wrong. We want to think about taxes looking forward so that we can plan, right? So we want to be looking at tax planning at least next year out and looking for the foreseeable future. How does that look, rather than just, hey, here's my stack of tax papers, be gentle.
Right. And when you talk about tax people, people say, well, I've got a CPA that handles all that. CPAs are great at filling out forms, but they do look through the rear view mirror. They're looking at the back window. They're looking at things that have already happened. And here at Floyd Financial Group, tax planning is really something that you look through the windshield. You're looking ahead. Is tax something that most people only think about come March and April?
Yes, absolutely. Then they say, hey, where's my W-2? Or not my W-2. In this case, it's 1099.
Right.
W-2 is when you're working, right?
Right.
So 1099, 1099-R, where are all those things?
Everybody wants to do tax planning on the 1st of April.
The 1st of April. I got 2 weeks here. Let's go ahead and plan.
When we talk about it in May, they're like, we'll get to that later.
Yeah.
Exactly. That's right. With taxes, we want to begin with the end in mind. And what I mean by that is sometimes people will come in and say, hey, I want to buy a new car. What do you want? Well, that car is, let's say it's, in today's world, a $50,000, $60,000 car is normal, right? So they say, well, I want a car, but I don't want to pay any payments. And I say, well, okay, so let's think about that. If you want to pay $60,000 for your new car, let's say your old car's worth 10, you still got to withdraw 50 grand. And we put that over there. That's going to put you up in the 24% tax bracket. So 24% on top of that 50,000 ends up being what, about 12,000. So I got to withdraw 62,000.
Wow.
I got to put it into a car that's going to depreciate in value. Let's think about this a different way. I know you don't want to have car payments, but in today's world, and even right now with interest rates high like they are, you can find 60-month financing for 1 or 0% out there right now. And you can keep yourself in a lower tax bracket, plus leave your money in your account working for you rather than depreciating straight up in your car. So little things like that make all the difference in long-range planning. So that's just one of the things that comes into play.
Yeah, and anything with motors, wheels, that sort of thing, they go down in value. And I don't understand people who go into dealerships and they will buy a brand new car. To me, a new car is a certified pre-owned that somebody else has taken the hit on up front. It's a couple of years old. That's probably going to be the best value. But you're right now. You talked about 60-month loans. I've seen them 72 months at this point in time. That is just absolutely crazy.
84
months
is the new
That's
maximum
crazy.
loan.
Keeping a car for 84 months, boy, you've really got to love that car. Can you imagine what you would have paid with the interest rate the way it is at the end of 84 months for a car that was, let's say, $55,000, $60,000? We were talking about Ford Broncos before we went on the air. I mean, these things can be, what, 80, 100 grand if they're all tricked out, right?
Oh, my goodness, yeah. I mean, cars today, it's just like everything else. You can find cars from $20,000 to $250,000.
That's crazy.
There, right? And they all do one thing. They move you from point A to point B, right?
Right. Well, there are a lot of good cars out there, too. You can find for 10 grand. I mean, look at those Toyota Corollas and things like that. They're sort of like cockroaches, you just can't outlive them. They'll survive a nuclear blast. We're talking about things that you can't do on your own, problems that you may have. Healthcare is another big one, Randy. People who are 65, suddenly they are overwhelmed. What can they do about that? Why can't they fix that on their own, or can they?
Here's the thing. Anytime you have a health issue today, you need somebody outside of you to be your advocate and to be there watching what's going on. I'm telling you, it is just crazy. There's so many decisions that you turn 65 and you retire. You got Medicare, then you got Medicare Part B as in boy, then you've got Medicare Advantage plans, you got Medicare Supplement plans, and then of course there's long-term care, which Medicare does not pay for. It'll pay for rehabilitation therapy and that sort of thing, but long-term care is another one. And I'll tell you, even assisted living in a place where you would want to be today, even right here in Springfield, Missouri, is somewhere between $7,000 and $9,000 a month.
Wow.
So it's something that you have to address. Now, we need to think about how do we want to address that, and let's see what our options are for the long-term care. But again, over time, it's tens of thousands of dollars. It can definitely drain your accounts and make it hard on your spouse when you pass away, because most people are not going to die at exactly the same time. Somebody's going to be left behind, and sometimes there's a long time between the death of the first spouse and the second one. We want to make sure that we don't leave them in poverty.
And Randy, talking about our topic here, mistakes that you can't fix on your own. Why can't people do these things on their own? Why can't they buy an annuity, or why can't they insure their cash flow? I mean, why can't you just DIY everything when it comes to your finances?
Well, everything is pretty complex these days, Jeff. I don't know if you've noticed that.
I have actually.
It's like I was watching this deal last night. Everybody knows on here that I like to ride bicycles, right? So This guy got on there and he said, all right, so let's say that you want to buy, basically there's road bikes, there's mountain bikes, there's e-bikes, and there's these things called gravel bikes. So a gravel bike is kind of a combination between a mountain bike and a road bike because it's just to run on gravel, right? And he said, so we go out here and we look at this one brand, and I think he brought up Canyon was the brand. He said, so here's this one bike. It's a gravel bike. They have 3 models, but within each model, they have 15 variations.
Oh, my gosh.
So we got 45 bikes to choose from. Which one is it, right? And it's no different. I mean,
that's only one bike company.
That's exactly right.
Right.
And it's no different if you go out here and you start looking at investments and you say, well, I'm going to invest in a mutual fund. Well, how many are there? Well, I would bet probably 50,000. And then you've also got these things called ETFs, exchange traded funds. What the heck is that? Well, once you learn what that is, how many of those are there? Well, probably another 50,000.
That's right.
And it's always changing and shifting. And you have to understand what's really inside those things and how current interest rate environments, what the market's doing, the price of oil, who's in office, what's going on with taxes. All these things come into play when you're trying to figure this whole thing out. And so when you look at Medicare, again, Medicare Advantage plans, supplement plans, and at least they've tried to make that somewhat where you can figure it out by assigning plan letters to the Medicare supplements. But the Advantage plans, there's so many of those, and each one's a little bit different. You've got to have somebody that can help you parse through all the potential scenarios for you and your situation to really make it effective.
And to give you the information you were kind of working through there, it's 148,700 regulated mutual funds worldwide, including all share classes.
So people say, well, that's
number.
a simple decision. I'm going to buy a mutual fund.
Sure.
Easy mode.
That's right.
By the way, your 401k plan has 10 options of the 148,000.
Yeah.
What would the odds be that that's the right ones?
It's good to have a guide to help you through these things for sure.
Talking about retirement mistakes that you cannot fix on your own. Here's the truth, folks. Most retirees don't fail because of one big mistake. It's a series of small mistakes that quietly drain your money year after year. So if you haven't had a second set of eyes on your plan right now, it's time to do that. Call us here at Floyd Financial Group for a retirement review at 417-889-7233. 417-889-7233. You worked too hard to get this wrong. Randy and Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our fine citizens here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Randy and Jake, I'm Jeff Shade, wishing you a happy and safe Memorial Day. Be sure to join us again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.